Picture this. 3 people, same starting point. 3 wildly different amounts of money to invest. One puts in $50, another drops $500. The last one, $5,000. They all buy stocks on the exact same day. Fast forward 1 year. The results, they're going to shock you. What you're about to see will completely change how you think about investing. Because, spoiler alert, the person with the most money didn't make the most percentage gains. And that's what actually matters when you're trying to build real wealth. I'm going to walk you through a real experiment I ran over the past 12 months. 3 separate portfolios, 3 different strategies. And by the end of this video, you'll know exactly which approach actually wins when it comes to growing your money in the stock market. But here's the thing, most people don't realize. It's not about how much you start with. It's about what you do with what you have. And I'm going to prove that to you right now. Let me set the scene. January last year, I opened 3 brokerage accounts. The first one got $50. That's it, the price of a decent dinner. The second account got $500. That's a car payment for some people. And the third account, $5,000. That's a serious chunk of change for most folks. Now, the rules were simple. Each account had to follow a specific strategy based on the amount of money available. Because here's what nobody tells you. You can't invest the same way with $50 as you can with $5,000. The game changes based on your starting capital. And that's actually good news if you're starting small. The $50 portfolio had one job: maximum aggression, high risk, high reward. With such a small amount, playing it safe makes 0 sense. You're not going to retire off $50 growing at 8% per year. So I went hunting for opportunities that could explode. Small cap tech stocks, companies nobody was talking about yet. Startups that just went public. Volatile, absolutely. But that was the whole point. The $500 portfolio took a balanced approach. This is where most beginners actually start. You've got enough money to diversify a little bit, but not so much that you need to play it super safe. So I mixed growth stocks with some established companies. Think half in exciting opportunities, half in solid performers. The goal here was steady growth with some upside potential. The $5,000 portfolio, that's where things get interesting. Because with more money comes more responsibility. You can't afford to gamble with $5,000 the same way you gamble with $50. So this portfolio focused on dividend stocks, index funds, and blue chip companies. The boring stuff that financial advisors love. Slow and steady. Compound growth, building wealth the traditional way. 3 strategies, 3 timelines. All starting on the same day. Month 1 was rough for everyone. The market decided to test my patience immediately. The $50 portfolio dropped 17% in the first 2 weeks. I'm talking about losing $8.50. Now that doesn't sound like much, but percentage-wise, brutal. The high-risk stocks I picked were getting hammered. There were moments I questioned everything. The $500 account did slightly better, down about 9%. Still painful, but the diversification helped cushion the blow. Some stocks went up while others crashed. That's exactly what balanced investing is supposed to do. The $5,000 portfolio barely moved, down maybe 2%. The dividend stocks just kept paying out. The index funds tracked the market. Nothing exciting, but nothing terrifying either. This is what stability looks like. But here's where it gets wild. Month 3 changed everything. Remember those aggressive small-cap stocks in the $50 portfolio? One of them absolutely exploded. I'm talking about a company that developed new battery technology. Their stock went from $7 to $23 in 6 weeks. That single position turned my $50 investment into $78, a 56% gain in 3 months. The $500 portfolio was doing okay, up about 12% thanks to some tech stocks recovering. $70 in profit. Nothing to complain about, but nothing crazy either. The $5,000 portfolio, up 6%, $300 in gains. The most money in absolute terms, sure, but percentage-wise, dead last. And this is where most people get investing completely wrong. They look at that $300 and think the big portfolio is winning. But flip it around. Which investor got better returns on their money? The person who turned 50 into 78, or the person who needed 5,000 to make 300? By month 6, patterns started emerging that blew my mind. The $50 portfolio was now up 94%. I'd basically doubled my money. But it was a roller coaster. Some weeks I'd be up 70%, other weeks back down to 40% gains. My stomach couldn't handle checking it daily. The $500 portfolio found its groove, up 31%. The balanced approach was working exactly as planned. Steady climbs, occasional dips, but overall trending upward. This felt manageable. This felt sustainable. The big portfolio was up 18%, $900 in profit. Great money, don't get me wrong, but it required so much more capital to get there. Then month 9 hit, and everything I thought I knew got challenged. A market correction came out of nowhere. Interest rates went up. Tech stocks got destroyed. Growth companies crashed, and my $50 portfolio got absolutely wrecked. In 2 weeks, I went from up 94% to up only 28%. I watched gains evaporate in real time. This is the dark side of aggressive investing nobody wants to talk about. What goes up fast can come down even faster. The $500 portfolio dropped too, from up 31% to up 19%. It hurt, but the diversification prevented total disaster. Some positions held strong while others fell. And the $5,000 portfolio down to 14% gains. But here's the thing, it barely felt like anything happened. The dividend stocks kept paying. The index funds just tracked the market down a bit. No panic, no stress. This is when I realized something crucial. Your investing strategy shouldn't just match your capital. It needs to match your personality. Because I'm going to be real with you. Watching that $50 portfolio swing wildly was exciting when it went up, but genuinely stressful when it crashed. Even though it was just $50. The final 3 months taught me the most important lesson of all. The $50 portfolio recovered. Those beaten down small cap stocks, they bounced back hard. By month 12, I finished up 112%. My $50 turned into $106. I more than doubled my money in a year. The $500 portfolio ended up 42%, $210 in profit. Solid performance by any measure. This is the kind of return that builds real wealth over time if you keep adding to it. The $5,000 portfolio finished at 23%, $1,150 in gains. The lowest percentage return, but the highest absolute profit. So which strategy actually won? That's the million-dollar question, isn't it? And the answer is going to surprise you. They all one. But for completely different reasons. If you only have 50 or $100 to invest, going aggressive makes total sense. You're not risking your rent money. You're learning how the market works. You're building experience. And if you hit on even one good stock, your returns can be insane. Just be prepared for the emotional roller coaster and the very real possibility of losing most of it. If you're working with a few hundred to a couple $1,000s, the balanced approach is your best bet. You get growth potential without gambling your entire stake on risky plays. You learn about diversification. You experience different market conditions across multiple positions. This is where most people should focus their energy. And if you've got serious money to invest, $5,000 or more, preservation becomes just as important as growth. Yeah, 23% doesn't sound as sexy as 112%. But making over $1,000 while barely breaking a sweat, that's the power of capital working for you. Here's what nobody tells you about these investing comparisons though. The real secret is in which strategy makes the most percentage gains. It's consistency and adding more money over time. That $50 portfolio making 112% is impressive. But if I stopped there and never added another dollar, I'd have $106. That's not changing anyone's life. But what if I added $50 every single month to that aggressive strategy, or $500 monthly to the balanced portfolio, or kept feeding that $5,000 account? That's when compound growth becomes truly powerful. That's when percentages turn into real money. The person with $50 can absolutely catch up to and surpass the person with $5,000. But it requires time, consistency, and continuing to add capital. Your starting point matters way less than your commitment to keep going. I also learned that emotional control is everything. The best strategy in the world doesn't matter if you panic sell during a downturn. And every single one of these portfolios had moments where selling felt like the smart move. The $50 portfolio when it crashed in month 9. The $500 portfolio during that first month of losses, even the stable $5,000 portfolio, had stretches where it just felt dead in the water. The winners in investing aren't the people who pick perfect stocks. They're the people who stick to their plan when everything feels wrong. They're the ones who keep showing up month after month, adding money, staying patient, trusting the process. So if you're sitting there thinking you can't invest because you don't have enough money, I need you to hear this. $50 is enough to start. Is it enough to retire on? Obviously not. But it's enough to learn. It's enough to build habits. It's enough to prove to yourself that you can do this. And here's something else I noticed. Managing that $50 portfolio made me a better investor for the bigger accounts. Because when you're working with limited capital, you're forced to think differently. You research harder. You look for opportunities others miss. You develop skills that serve you forever. The amount of money you start with doesn't define your potential as an investor. Your willingness to learn, adapt, and stay consistent does. I've seen people turn $100 into 6 figures over a decade. I've also seen people lose millions because they didn't understand basic principles. Start where you are. Use what you have. Learn from every win and every loss. Build the habit of investing regularly, even if it's tiny amounts. Because 5 years from now, you'll wish you started today with whatever you could afford. The stock market doesn't care if you're investing $50 or $50 million. The same rules apply. The same opportunities exist. The same potential for growth is there. The only difference is scale and time. Your homework, after watching this, pick your starting amount. Be honest about your risk tolerance. Choose a strategy that matches both. Then start. Not next month. Not when you have more money. today, right now, because the best investment you can make isn't in stocks at all. It's in developing yourself as an investor. And that journey starts with whatever amount you have available today. Click the next video to see exactly which stocks I picked for each portfolio.